Good evening. This is the Elliott Wave update for the S&P 500 for Sunday, July 24th, 2022. On Friday, the markets early, including the S&P, poked back above that 4,000 level, while the other one, in the NASDAQ, poked itself above 12,700. Here in the S&P, though, we did move to a slight new high. I believe it was 4,017. And then that level was rejected. The market dropped pretty sharply, dropped back below 4,000, obviously, and closer down to 39.50, finishing up the day just about 39.65. Now, coming off just a little bit here, not by a whole lot, but again, we are moving into an important week for direction because we'll have a lot more information. So there won't be the punditry, what if this comes out? What if the Fed does that? It's now we will know. So it is all going to be up to interpretation, but let's go over very quickly what we got coming during the week. Pretty much tomorrow, not much of anything. Tuesday, it all begins. We have consumer confidence, we have new home sales, and those both are likely going to come in not in line with, maybe in line with what expectations are, but they're not going to be an improvement over what was reported last month. That's my opinion there. Could come in, and that would even shock me. So on Wednesday, more important, we have durable goods, international trade in goods, both important. We have EIA petroleum, which is important if you trade crude, or you're trying to get a gauge from gasoline prices, which direction they should go, and how that's going to help your own personal pocket. Now, more importantly, here we have at 2 p.m. Eastern, the FOMC announcement. That is Big Daddy. That is the one where everyone's waiting for, because we need to know what, and this is truthful, we need to know what the Fed, how aggressive they're going to be in trying to get a grip on inflation and actually putting a floor under things where we can maybe stand and trade upon it and maybe look forward to a couple of things, but having an idea that the people in authority, when it comes to our money or our interest rates, actually can put policy together. They can get a grip on this inflation. They can slow things down. They can do it without necessarily destroying everything, so that we can just get back to repricing. That's essentially what it still continue and needs to happen. So during that whole process, we run through what we call runs up in and out of value. Now, on top of all of those economic figures that we have going on, we also have Apple, Apple, Amazon, Meta, Microsoft, and on down. And then I'm sure there's a lot of other miners that are all reporting Tuesday, Wednesday, and Thursday of next week. So a lot going on that's going to point to hopefully completion to this get this minor fifth in. I am still expecting that. On an Elliott basis, we're still coming off in an intermediate C wave. We've only gotten through wave 3 on my calculations for minor wave 3 of that intermediate C. So this would be a fourth wave. Now, just a little Elliott talk here. Yes, a lot of these funds have turned bullish. Their models have turned bullish, and they react to the models. So the inflow of capital that I kept saying, gee, look at all this money that's coming in during a lot of the updates that I made last week, was on that premise. Again, not making any judgment on why they're buying or what they're buying, but now we get a little bit of an insight that, well, what they did was reallocate, rebalance portfolios to go with what their computer models were now shifting to a more bullish posture. So you go and you invest in different things. Obviously, I think that that's what took place. Now, under Elliott, and one of the observations that he made, and another of my early teachers was within the writings of Prechter. He was the one that said, in fact, he mentions it in one or both of his books, or several of his books. But he was talking about that in a fourth wave. Part of the characteristic is that a lot within the market players flip, and they're basically early. Yes, the market is kind of due for a rally. The market is getting ready to put in a minor fifth wave low, which will complete an intermediate C wave, which in turn will complete a primary A wave and set up the stage for a beautiful primary B wave rally. Now, I'm not going to stick a bullish or bearish sign on that B wave rally. I'm just saying this is what I expect to happen. But I also know that the characteristics of a B wave are not necessarily convincingly long-term bullish. But it's going to be a month or two, or maybe even more, of a rally. So in fact, it could be if wave A, which really started in January here in the S&P, and if wave A ends at the beginning of August, so we basically have gone 7 months. We're into the 8th month. So wave B, at least 3, 4, 5, maybe 6 months. But it'll be a rally, a decline, and a rally. Not a decline to a new low, but, you know, an ABC, right? ABC. And it's the other way around. ABC. Here we have another ABC. So maybe it'll look similar to that, but it can then we go back to a corrective phase. We go back to trying to determine, is it going to just, you know, be a flat? Is it going to be a zigzag, et cetera, et cetera? So we're still moving through correctives. This is going to be the way it is for a while, folks. We're going to be moving constantly from one section of the correction to the next section of the correction, which happens to be the rally, counter trend, right? Trend is down. We have a counter trend move coming, larger counter trend move. And so again, how I count this, I do the first ABC of intermediate degree produces the A wave of on the primary degree. Then we still have a primary B wave and a primary C wave, which will be down, strong down, because we're up a degree. So there will be 5 waves of intermediate degree within it. So you can see we're moving our way up that ladder. So the moves are going to get bigger. And then we'll be breaking them down just like we did this one. But once that primary wave C is done, and I suspect that's going to be the one that's going to take us down, because then when we're done with that, we will have been finishing up the cycle degree A wave. And it's that cycle degree A wave that I think will get down and reach the pandemic lows. So if I'm going to come, I don't need to go out that far. Weekly. Here. So back down to 2248. That's actually the number, because it's 62%. So that's the fib number, but it actually can go all the way down to there. I do believe that that is where cycle wave A will be put in. So we're just finishing up primary wave A. And we got a primary wave B, a primary wave C, and then that completes cycle wave A. Then we have a cycle B wave and a cycle C wave, and that's the one that I think can take us down, a cycle C wave. So it's pretty big. That's the one I suspect will bring us back to likely here, as low as there. Those are big numbers. I get that. But I think that's what can take place. Then we will be set. I want to tell you, cycle C bringing us down to there, and we're out there. This isn't next week. This isn't next month. This isn't next year. This is out there. And when all that takes place, it's setting up for the next gigantic economic expansion. So finally, we'll have reached the level where it's like, okay, everything's back under control. Money's under control. We're going to be building off of a stronger base, not one that's wobbly. Everything will be more pointed and more focused in terms of having all these fires going on all around us, economically, geopolitically, just everything that affects how we live, has something going on. So, climate, it is hot out there on several different fronts. Let's just leave it that way. I know many parts of the country, you're all sitting this weekend going like, oh my God, if it gets any warmer, we're going to be frying eggs on the street. So, but you're not the only place it's hot. There are a lot of economic things that are hot. There are a lot of things that are dealing with interest rates that are hot, the hot measure, political things would go very hot out there, a lot of stuff going on. And so that produces what we have. So in any case, I think for tomorrow, we must leave open the potential that the market can turn one more time, put in an additional high above 4,017, complete the C wave, and finish it up. We have that resistance at 420 to 440, and then 4,075, 75 up in there. That would be the 50% level, but that would kind of be the max. Now, for the market to do it, it's really going to have to pick it up and just go. But I have said that, and it did it on Friday, and it did it on Thursday, et cetera, et cetera. So I leave it there. Don't be surprised should they do it. Markets will go to value even on the buy side, even on the sell side. So if it continues to break down and we get below that daily 50 and the 4, then I'm looking for the 8 and the 20. And that would be another, 30, 40, 50 points coming off. And then we start to pick up some support, but that isn't down to like 38.23. And then if that's the high and we're in minor wave 5 down, then I am looking for these to get broken. How quickly should not be a problem if 5 is deed in control. But again, I think it's going to be pushed by some of the resolution to all these economic numbers, how they're going to be interpreted, what they really spell. But I think a lot of that rolls right around Wednesday afternoon at 2:00, and then at 2:30, when we can start to put some meat on to what our situations are and how much longer we should dawdle here or there, or what's the repricing and what do we need to do. So again, I won't trade bullish or bearish. I would just continue to trade the number because in essence, that seriously is what it is all about. We're just now applying these different factors that are going to come in. So higher interest rate, what does that do to value? It should change the value of the indexes that are, based on this. It should change the value of the bond market. It should change the value of the dollar. It should change the value of all these different instruments that roll around that factor, that interest rate factor. So again, sits at the top of the pecking order in my mind. So that suggests that when we get that information, it's going to roll all the way down through it all. If we're getting an idea about what interest rates are going to do, i.e. the Fed makes their move, that all then gets filtered through a lot of stuff. And then we get our answers, and we get what we're going to do, and then we get the movement because the computer models will change. All right, I'm leaving it right there. We got a lot to think about this week. Have a great trading day tomorrow. Please continue to follow the moving averages, the Fibonacci. If you are using Market Profile, learn more about it. Get used to how points of control play out, value area highs, value area lows, how they shift, how it measures supply and demand. All it is a measurement of supply and demand. Demand must go to value to find the supply. So, and that comes on both sides. If the demand is from the sell side, they're looking for where's that value area where the buyers will consider it valuable enough to purchase. Same thing on the sell side. All right. Our next update will be on Monday, the 25th.